not, for any reason, ever share your private keys, passphrases, passwords, or click suspicious links. Everyone all the time is trying to steal your stuff, so go slow and be careful. There's no point making all this money just to give it to a thief.
Are you tired of all the uneducated noise you're getting from the droves of YOLO meme coin peddling douchebag gurus out there trying to use you as their exit liquidity? Would you rather learn a competent university-level set of skills that will guide you in managing and investing for the rest of your life? Join us 3 days a week at Digital Investor. Develop your knowledge of game theory, cognitive bias, macroeconomics, monetary theory, investment theory, psychology of the crowds, and more. For more info on Digital Investor and how it can help you, reach out at nickblacknext.com.
Bam! I think I got through most of it already. Let's see. Let me turn my little microphone up here so I can hear what you guys hear. That's important. You got to match the microphone to what you think they're going to hear so that you hear what they hear. Otherwise, you're talking all crazy and people's eardrums are getting blowed out. That's not the goal. Bam, bam, bam. Thank you for the likes. Thank you for my little hit of electron-based dopamine. Let's see. What's going on? Well, a lot. In the crypto space, it's all a lot of kind of like side-to-side action, and most of the space is kind of gross if we were to look at markets like we did yesterday and like we will obviously do tomorrow. So we're going to stay away from that so much as kind of more focus on the macro. We'll spend a few minutes. If you guys have questions, Q&A type stuff, we'll knock that stuff out. Keep it specific enough that I can answer it. And if you ask a question, maybe think about the question. And if you know that the answer is likely a 45-minute answer, then we probably should steer clear of that question for the meantime. All right. Yes. For those of you that didn't catch the show yesterday that Brandon and I did, we did a cool analysis of the path to $2, what I think is the path to $2 hypercycle, which I don't think is a very difficult path. I think it's quite obvious. But again, it's not a price prediction. It's just one of many possibilities. You know, still lots of things have to happen, line up and all that. But my eyes are focused on spring of 24, March of 2024. And I think that's what people should be focused on as far as hypercycle is concerned. I think that's important. Okay, some OTC news. There's a lot of people that are trying to arbitrage, that are trying to do stuff like that. If you go to Node Market, now listen, Linda. The exchange, while it's mostly built, I mean, it's completely built, but we're still waiting for audits to come back. So nothing is active. You can't buy or sell anything right now, but you can bang around and play with it. And we're doing a lot more cool stuff. The twin token will appear here soon enough as information as far as what's moving forward and all that kind of stuff. But we hope, I don't know, 10 days maybe. I'd have to ask Brandon for an exact, but I think a week to 10 days we may be, that bad boy may be there. Let's see. Jim asks, how much do we know how much HyperPG Pool will be charging for hosting nodes? I don't know. They would have to press release that. Now I can ask Tufi. We're going to record this evening for This Week in Hypercycle, which will air tomorrow morning at 7 a.m. I'll ask him tonight or whenever we record. But he may not have that answer either, because he doesn't run HyperPG. HyperPG is a partnership, and they have their own leadership structure and all that. Okay. Let's see. Bam. Can you tell me how to find my node NFT in MetaMask? I don't see it, but the transaction went through. So Tracy, it is probably there. We actually have a video on that. So if you go look, there's like a tech tips playlist, and I'd have to go bang through. I'm not going to do it right now while we're on the air, but there is actually one of the last tech tips we did is to go and like, you can not only can you look up, like when you go, here, I'll use this because you can get there from here. We go node market, by node license, and eventually this will all be at node market. We're swapping all this stuff out so that what's at Digital Investor will just be membership information for Digital Investor. And then what's at Node Market will be all of the node stuff. So all of this stuff is going to be at Node Market. Okay. But when you grab these things, you can actually check. I mean, you can look at obviously the details of all these kinds of things, but you can look at your particular purchase in the list of all the purchases. So, I mean, anyway, there's a lot going on here, but we're going to get all of the node-based stuff over to Node Market where it belongs. It's just a little bit of plumbing that we have to do. So do not fret. But yeah, and depending on when you bought it, Tracy, if you bought the node a few minutes ago, Brandon usually reconciles those every couple of hours. So do not worry. It is in there. The best way to do it is to check, go to OpenSea, because MetaMask itself is not the best place to look at NFTs. Go to OpenSea, put in your MetaMask address, and there you'll be able to see everything that's in there. That's the easiest way to do it. Bam. Okay. Question. How do I stake Hypercycle when the MM choice does not come up as a wallet connect? Well, you're not, what do you mean? First of all, if you're staking, then you're probably referring to how would you post those tokens over at Singularity DAO. And if you're at Singularity DAO, you would go to the unbonded vault for the type of token you have, whether it's the Ethereum network or the Binance network. In whichever one it is, make sure that your wallet is connected. So you'll go through, you'll click their little boxes, and then you'll connect your wallet. When you've signed in your wallet, then when you look at the unbonded vaults, you just select the unbonded vault that applies to your token, whatever token that is that you want to stake. That's Hypercycle. There's an unbonded vault for Ethereum Hypercycle, an unbonded vault for Binance-based Hypercycle. And you click, it's 2 transactions. It's one to approve and one to stake. So you're going to have to click a yes on the approval, a yes on the staking. Does that make sense? So it's 2. All right. When I did it on MetaMask, I had to give permission for OpenSea to MetaMask. Yes, but not to look. So John, anybody here can look at anybody else's MetaMask wallet. You can look at it. You can't mess around with it, but you can look at any wallet. Anybody can look at any wallet by simply going into the search bar and putting in the MetaMask address. So that's cool. I'm there, but wallet won't connect. Maybe a browser issue or something like, again, I don't know. And we probably can't solve it while we're, doing this right now, but it is doable. Maybe back out, maybe look at which browser you're using. I either use Chrome or I use Brave, and that is it. So you may want to look and see which browser you're accessing from, but it should be also a lot of times you need to re-click the little MetaMask, the little fox guy, because sometimes it'll be waiting for you to confirm that you're allowing the wallet to say hello. Don't do it on a do not use these devices to do anything with Singularity. Don't use these for anything crypto, period, full stop. Make sure you're on a laptop or a desktop or something like that. You're on Apple. We'll try Brave. Apple browser? Apple doesn't have browser. Do you think Hypercycle has one more pullback before Moon? I mean, there's always pullbacks. You're going to always get like these vacillations. Let's take a look. I don't want to dwell too much on the price because that's not really what we're kind of not what Tuesday and Thursday about, but let's just take a quick gander. Oh crap. That thing's up there. Yeah, it's just flirting with the all-time high, isn't it? Oof. Well, I hope you guys played those cards right. Look at that disparity. So there's your deal. I mean, there's your deal right now. You want to know the way to play it? You want to know the way to play it? If you're planning on staking, if you're planning on holding the token, if you're planning on, I mean, it's right there. We're going to talk about intellectual arbitrage here in a minute, but think about it. If your idea is to take the tokens and marry them to nodes, well, you've got a 20% plus discount right there staring at you between the BNB token in PancakeSwap, using PancakeSwap to do it, or the Ethereum token. So there's a 20-something% discount staring at you. Almost 18 to 20, depending on like where you actually fill at. So, you know. All right. 4 years connected. Yeah, that's weird. Mine connects easy. Brave is pretty easy. Chrome is easy. Some of the other ones are not so easy. Sometimes they're garbage. Okay. So let's get away from prices. We don't really care so much about that. It is interesting, but in the greater context, 70 cents is not $2, $5, $10. And also, that's just one piece of it. The price of the asset's one tiny part of this. The bigger part is getting a bunch of nodes, getting them in production, having them split over the next 5 years. You know, well, in 5 years, if you were really banging on hardware, you would be probably split. You'd have all 10 splits, I think. That would be right at the edge of it. But if you were scaling effectively, you'd have all 10. You'd be looking at a different world, my friend. Are we going to get an airdrop rewards from AJAX? Yes, but it's not going to be the same kind of airdrop as a lot of people think. It's not going to be the shower you with tokens so that people can immediately go and sell them. It's going to be a kind of a learn to earn type thing. And those tokens likely will have a lockup period where you will, part of the process is they're going to give you tokens to put into the ecosystem. They're not just going to, open the water hose and shower people with tokens that they immediately sell, because that's not the point. These loyalty rewards are to build the ecosystem, not to shit on it. So like, yes, there's going to be an airdrop. It's going to be great. There's going to be a lot of airdrops coming from Singularity Net, actually. Probably going to be a nice pump in the token based on that. But again, not advice. You got to do you. But I think it probably makes sense that those tokens would be locked. So when they airdrop you, like the hypercycle stuff, it'll be like learn how to set up a node, learn how to marry tokens to into a node license, all this kind of stuff. Learn how to pledge them into one of the pools or whatever. And there's a good chance that those tokens will have not a lockup, but they'll be introduced into tilling and then into compute as part of that. And then after a certain amount of time, they would unlock. You can do whatever the hell you want. But I mean, I don't know why people would bring tokens back out of the node licenses. If you wanted to exit, you would just sell the node license. You're like, sell the node license? How on earth would I do that? Well, you would go here, and where it says explore nodes, that's going to be a marketplace for buying and selling node licenses in various states of production. And it's not just for a specific group. Anybody gets to participate. The other thing, too, that I think is missed is the whole point of the hypercycle ecosystem is that everybody gets to participate, not just simple me, my buddies, some secret cabal, and with a secret handshake and a special way they tie their shoes. Everybody gets to participate. No one gets an advantage on tilling. No one gets an advantage that all this bullshit. No, everybody gets to play. And so I think that's an important aspect that was getting a little bit, that message was getting a little bit perverted. So I would think we need to get back on message. Okay. If hypercycle is going to airdrop, like you said, wouldn't it have to happen right away? No. Why would it have to happen right away? Tim, buddy, could happen a year from now. There's no need for them to do this. It's something that all of the companies that launch under the AGIX, under the Singularity Net kind of umbrella of assets. So they do this to build those ecosystems and to reward the kind of the long-term loyal Singularity Net asset holders. So they usually take it's between 2.5% and 5% of the total supply of tokens, and then they'll distribute those to the AGIX holders in the community. Yeah. So it wouldn't have to happen right away. And again, so that we can kind of bring some closure to this. Yes, you would have to learn to marry tokens to nodes and all that, but there's no reason that has to happen right now, this second. I mean, the people that are in the community right now are the very, very early adopters. So that could be a month from now, 6 months from now. That could be when compute starts in March or April of 2024. I think Hypercycle's main focus right now is getting all of their code audits to come home clean, get their dApps built, functional, to work on the user experience of all of those dApps so that everybody can get in and out of the assets, convert, marry tokens, unmarry tokens, do whatever you'd like to do. Well, that's what their main concern is. The early adopters, those of us that are here right now, giving us more tokens doesn't materially change anything. So until they have all of this software ready, I know people are very hyped and excited, but you still have to remember that this was an 18-month roadmap that started on May 8th. Well, we're not 18 or 9 or any, I mean, June, July, August, September, not even October yet. We're not even at month 5 of an 18-month roadmap. We got to slow it down. we got to dial it down a little bit. Give them some time to get their code pushed out. Let's see. For AGIX airdrops, would it matter if the tokens are at or in the vault? No. If you have your tokens vaulted with Singularity Net, or if you have them in MetaMask, same. They both count when they do snapshots. Is Singularity DAO taking snapshots now? No, they'll announce all that. They will announce all of their snapshot dates and all this. They don't trick anybody into doing it. Snapshots for the purpose of airdrops are very public. I think you have to have 2,500 was the minimum amount of AGIX tokens it took to qualify in the past. I don't know what that number is now, but I would assume it's the same. Let's see. That's funny. I married my wife 4 times in the past 37 years, so I don't think I'll have any problem marrying my hypercycle tokens to nodes. True. And yeah, and on some of this stuff, when I'm kind of abrupt with the answers, I'm not trying to be flippant. Sometimes we just don't have any information. I mean, I am close to hypercycle, but I'm not back there like, coding and doing all that old fancy stuff. So let's see. Brandon actually just texted me. He said, wait, let me read it and see if I can say it. Let me make sure it's not something to add USDC, USDT to node market. ton more through contract compared to East price. They tell me it's not ERC20, which makes sense. I guess everything is very simpler. And no, we need to wait. Okay, so 5 extra days. Yeah, so about a week to 10 days to make sure that we have USDC and USDT, not just Ethereum. Yeah, so we will wait. So we will wait the 7 to 10 days it takes and make sure that USDT and USDC are transactable in the node marketplace and on the OTC. Yes, that is good. Okay, today we're going to talk about the concept of intellectual arbitrage. We're also going to talk about kind of crypto versus Fed funds and what the basic thinking is up to about the end of the last bullish, stupid, cryptarded phase. And kind of the way people look at risk on versus risk off, Fed funds, low, ZERP policy, higher interest rate policy, and what the assumptions are in the market by most players. And the reason that's important is because this is an anemic kind of tiny market right now, but it won't be forever. And when it, investors that are not super deep in the crypto space, they're not early adopters, that people are, that might be coming from other markets, just looking at very risky places with a lot of volatility as a place to invest and turn some currency units. They follow more kind of established like trends in like overall macro investing, which is why many of them miss it, and they miss it big, but some of them hit. So we're going to talk about that. I was going to show something else. It's not that important. It doesn't matter. Yeah. Anyway, so let's go ahead and do that. Let's turn our gears that way. If you can, throw a like up there, because as this is kind of more educational content, we want it to get out to as many people as possible. It doesn't take any time to just click the like button. Yeah. So there you go. All right. So let's get into the guts of it. Bum, 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 bum.
Hello. You're late.
You're bad at math, but I'm giving you an A+ in confidence.
Just doing what I gotta do.
Extra credit.
Bam. Okay, you're going to see yield curves up there. Well, why? It's going to be important in a second. For now, just kind of bear with me. So we're looking at this kind of concept of intellectual arbitrage, and this is the best way I've found to be repeatedly successful in and around this space, which is very volatile and mostly anemic markets and traded by a bunch of whack jobs, mostly, is that I've stayed, 6 to 9 months ahead, 9 to 18 months ahead of the market. I don't look at short-term trades. I try to look at longer-term investments. For me, the difference between a trade and investment is the time horizon. And I look at a trade as being something that's 12 months or less. I mean, some people trade in and out in seconds and all that, but I look at things that are 12 months or less as a trade, 12 months or more is an investment. Now, an investment can become a trade if the information changes in the same way that a trade can become investment. But anyway, if you try to live in your mind just even 6 to 9 months ahead of everyone else, you're going to find yourself winning a lot more consistently, right? In the same way that if you're driving a race car, you don't look in front of the car. You look way past. You don't look right in front. You look as far in front of the car as you can, out to the next turn, deep into the turn, because you want to be able to anticipate things before everyone else is dealing with it, right? You don't want to you want to be acting in advance, not reacting. Does that make sense? So today we're going to kind of delve into that concept of intellectual arbitrage. and its potential significance in volatile markets like the cryptocurrency space that we love. I hope if you don't love it and you're listening to this, well, then you might end up loving it. I don't know. So we got to define first, what is intellectual arbitrage? At its core, intellectual arbitrage refers to the act of capitalizing on a disparity between what the market knows now, what they think they know, and what you anticipate it will realize in the near future. It's akin to seeing around a corner in the financial world, maybe predicting trends or changes that the rest of the flock hasn't recognized. And you guys know, well, there's nothing on the slide, Larry. Here, I'll remove it, but the maturity dates, that's what a yield, you guys know what a yield curve is. That's what a yield curve is. There's not like any secret words that are materially changing the discourse. But anyway, so this is the beauty pageant analogy that a lot of people use. And that is that in a beauty pageant, well, here, let's do a little Q&A. If you go to a beauty pageant, you're one of the people voting in the beauty pageant. Are you voting on who you think the prettiest contestant is? As a member of the crowd, you're voting on who you like the best. Who you like the best may not be the prettiest contestant. Also, that's a whole weird thing. Like, what do you consider pretty? Oh, she's so cool. He's cool. Oh, whatever. As an investor, you don't give a shit who the prettiest is. What all you care about is, can you front run everyone else's vote? That's all we're trying to do. We're just trying to figure out who those sheep are going to vote for and get there sooner and get embedded in that asset as cheap as possible. And when they come with their votes, they can be part of our exit, or at least they can give us some material gain while they catch up to what our assumption was well in advance. This is an intellectual arbitrage. Yeah, not just betting on what the crowd likes best, but doing it well before they even get ready to vote, well before the contest. And that requires like doing some research, like who are the contestants? Will they be able to show up? All this kind of stuff. So, this is important in just consistent investment strategy, right? And it kind of makes sense. I want to be thinking 6 to 9 months ahead. So, why 6 to 9 months? So the time frame is strategic. It's short enough to make actionable decisions, but long enough to identify and act on discrepancies before the majority of the market catches up. If you're living 3-4 years out into the future, that's cool and that's important. It's very difficult to invest that way because there's so many moving parts, so many particle interactions that you can be too early and you can erode your capital waiting to be right. Some of these like, oh God, older investors and stuff, they're like, I had 2 good decisions my whole investing career and I got rich. Yeah, so you can enjoy it at the ripe old age of 89. It doesn't do, at least this right now in our lives, it doesn't do any good to strike it rich at 89. It really, you want to at least hit some home runs in your like 30s, 40s, 50s, 60s, 70s even. If you're in your late 80s, it's hard to really enjoy it. So the idea is it's great to ponder way out in the distance, but your decisions need to be a little bit more actionable and a little bit more in line with like where society is. So that's why the 6 to 9 month mark is pretty interesting. Now, what is the value in volatile markets? So, cryptocurrency sector, we all know it's incredibly illiquid. It's illiquid assets on illiquid exchanges. That's why we're building an OTC. And it is especially ripe for this kind of strategy. Why? There's 2 main things. Information asymmetry in the crypto space is really high, and sentiment-driven movements, right? So those 2 things alone. So cryptocurrencies and their underlying technology are, they evolve very fast. Little changes. I mean, listen, from week to week, the information we get out of Hypercycle or SingularityNet or just the AI space in general, it gets people motivated to do different things on a week-to-week basis. That is fast. And this pace can lead to significant gaps in knowledge and understanding among market participants that are in every day versus check in once a week versus check in once a month. Does anybody here think you can invest competently in the crypto space by checking in once a month or once a quarter? I had a client that used to hit me up once a quarter. How we doing? Well, I don't know. Do you have time for me to explain the whole goddamn universe to you from the Big Bang on? Oh, it starts with hydrogen and helium, and oh my God. You have to be real time, a real time participant. Now, if you are, you can win huge, but you just can't check in once a quarter. Man, you can't even really check in once a month. You need to be you got to be looking at this stuff twice a week, period. It just needs to like become another job. There's no fire and forget. This is not like a stinger. This is not fire and forget. Okay. The next thing is sentiment driven. This is a sentiment driven market. Cryptocurrency prices can be influenced heavily by public sentiment, mostly by right. Sentiment moves mountains, right? So, and this makes these assets particularly sensitive to future events or developments that can shift perceptions. What happened? Who here remembers? You got to, all of you, the craziness of January of this year for AI-based assets as GPT really launched and started that kind of massive onboarding of like 100 million users during January. You guys remember the nosebleed pace at which Singularity Net went, how fast it moved? I mean, people went from like nothing to rich quick. Not rich, but, well, not rich. Ben Gorsel's rich. So you see how fast these assets can rocket. Yeah, it wasn't just AGIX either. It was AGIX. It was Fetch. It was NewNet went from less than a penny to 10 cents. There's what, 1,100%? Like all these assets crushed. Yes, a lot of people got 10Xs and took some profit. This happens quick. That was in about 8 days of January, that movement. If you had been checking into your account every 9 days, you might have missed that. If you're checking in once a month, you definitely miss that. If you're checking in once a quarter, you don't know what the hell's going on. So you have to be a participant because these are highly asymmetric markets where the information changes so quickly that if you're not involved on a day-to-day basis, you lose because you'll lose opportunity again to front run or to take some cash off the table. And they are sentiment driven. Okay, so how do you master the intellectual arbitrage part of it? You're like, okay, I get it, but maybe I don't have 100,000 IQ like Ben Gortzel or Tufi. How do I benefit from this? Well, I mean, not many of us have those kinds of absolutely ridiculously high IQs. We don't need it though. The cool thing about most investment strategies, most investment technique is these are skills. And skills can be taught. Talent is not taught, right? And so you can be brilliant at the basics, continuous learning, diversify your information sources, plan, scenario planning, contrarian mindset, especially against yourself. So let's break those down for a little bit. Continuous learning. To stay ahead, you need to be in a constant state of learning. And you need to think about thinking, right? This involves keeping up with technical advancements, regulatory changes, macro and microeconomic factors that can influence the market and then the market in your specific asset. Last couple of days, we talked about the microeconomics of hypercycle. We talked about, thinking about it in terms of a commodity and what that might mean. And then the commodity of the node licenses and what that might mean and how that ecosystem as it expands, where are all those tokens going? They're getting hoovered up into nodes, which will then be participatory and earning money in compute. Do you think anybody that's earning money on a daily basis with their hypercycle tokens married into node licenses is going to unwind those if they're making money every day? No. And as those tokens go in a one-way direction and get hoovered up by those node licenses or lent into node licenses through like HyperPG or HyperPools, and those tokens get locked up, they're not hitting the market. So if you have a one-way path for this commodity, that creates a huge supply shock, a vacuum, an upward vacuum. Anyway, so that's a microeconomic study of the macroeconomic backdrop of how the AI market is like absorbing, well, AI in general is eating the earth. So it's important that you stay continuous in your learning process. You need to diversify your information sources. Don't rely solely on mainstream news, CNBC, but you know what? I still look for about 20 minutes a day just to listen to what they're blabbing about. It's mostly, they have interesting and kind of sometimes perverse incentives. I don't think CNBC is evil, but I think it has a lot of opinions, and it's mostly advertising. You know, when they have these douchebags come on and talk their books and all this kind of stuff, those dudes, they don't have enough time in the day. So if they're coming on CNBC, it's to talk you into something. They are selling. All of those dudes, they're selling for sure, 100%. So just understand that. So don't rely on only mainstream news. Delve into white papers. Do your 5 T's. Listen to expert discussions. Every now and then, go catch a Twitter space. Explore niche forums. I warn you to be careful I warn everyone about Discord, in that Discord is just where bad, malicious links are. I'm not saying any groups are bad. Discord has all sorts of cool groups. There's tons of, like, Discord is awesome. Lots of people use Discord. Just don't click links ever. Don't accept friend requests, and don't click links. Anyway, there's your little warning about it. Anyway, but the whole idea of diversifying your information sources is to access information that hasn't yet become common knowledge. I go through, one of the cool things you can do is on Livecoin Watch, the app, the news stream, even though 90% of it's bullshit, I still scroll through it and just read the titles and see, oh, is there anything interesting there? And mostly the titles are bullshit too, because it's going to lead you off on it's going to be like, this coin is going to do good. And you're like, oh yeah. And you read it and it's like some weird, crappy meme coin thing. But there is some good information sandwiched in there. But I do want to know on a regular basis what people are thinking, what the mainstream in the crypto area, what people are thinking. And you can even learn a lot by, if there's a common theme that you're getting in the diverse information sources that you kind of rely on, you'll start to say, okay, I'm starting to feel the theme. And when you get that, now you say, okay, now how do I get ahead of that? And yeah, no one's talking about hypercycle because it's still incredibly, this is a tiny, tiny niche group, if you really think about it. As they go live, I think you're going to get a lot of people excited about it as they go live in 2024. This is like right now, everybody has an opportunity on these AI assets that I don't think they will ever get again. This is not one, like AI is not one, you're not getting a second bite at this apple. If there was any pullback, you already saw it. Now, it doesn't mean prices of assets won't go up and down as they always do, but in general, every day is the best opportunity to participate because it's going to absorb more and more and more. Anyway, scenario planning. Regularly ask what if. Consider various potential outcomes and the implications of those outcomes on the market. And bear in mind, these are illiquid assets. So a little bit of movement can sometimes look like a lot. Like if someone goes and sells 250,000 hypercycle tokens right now, maybe they would, maybe they wouldn't. Yeah, that would bully the price down probably 8 or 10 cents. You'd be like, oh my God, it's crashing. No, it's not. Somebody wanted to sell 250 because they want to buy a car, right? It's that simple. And you don't know where anyone else is in their investment life. You also don't know who may have to make a house payment or pay for a car or whatever, right? Like life sometimes gets in the way of your investment journey. So don't, especially in illiquid markets, don't follow too much the ups and downs of the price and try to read in the tea leaves, right? Just train your mind to spot opportunities and risks 6 to 9 months ahead of the crowd. I made a pretty good sized investment in hypercycle, as did many of my my brethren in the digital private clients, well before a lot of other people. That has paid off a lot. But we did the same thing in Cardano. We did the same thing in SingularityNet. We did the same thing in NewNet. We did go down the list. I mean, even now that the Singularity DAO price is all the way down as far as it is, I think I'm still at an 800% return, not counting all the staking over the last few years. So I'm well over a 10x. Anyway, the point is because being early, being first, right? Be first. So, okay. And then it is important to have a contrarian mindset. So being successful in intellectual arbitrage, it means sometimes you're going against the grain because if everybody got it, there'd be nothing to arbitrage. There'd be no opportunity. So when the crowd zigs, you need to have the courage to to express your investment thesis. Like you need to have the internal fortitude and the conviction to do what other people are not doing. Right? If everybody gets it, the opportunity's gone. So it's okay if you think you see it and they don't. On most of the things that I invest in, I'm like, I think people aren't seeing it. And I'm always hesitant because, when you see something and you don't think anyone else does, obviously you go, wait a minute, what am I missing? Well, the better you get at kind of crossing off the list, all the things that you think, what am I missing? You're left with an investment decision. You act on it, have the conviction to act on it. Okay, so let's talk risks really quick. As with any kind of investment strategy at all, period, there are risks. Predicting the future is, inherently impossible, but humans are relatively cyclical creatures. And so you don't have to predict the future, but you can predict the direction pretty well. And that's about all you need to do. You don't need to know with pinpoint accuracy. So you might be able to predict a trend and not the specifics of it. And obviously the market might take longer than expected to recognize and react to it. You know what? More the merrier. The longer it takes for them to figure it out, the better. Only you have to have the currency units to stay in the trade. This is why I say don't take on leverage to invest, right? Because markets can remain irrational a lot longer than you can remain solvent, especially if you have some kind of debt service. So, always ensure that your strategies are grounded in thorough research and not just whimsical, bullshitty speculation. So essentially, intellectual arbitrage, especially in fast evolving spaces like cryptocurrency, it can be I think it's a game changer, and it needs to be a way of life. You really have to adopt this strategy. And so by keeping your mind firmly 6 to 9 months ahead of where we are right now, you will position yourself to capitalize on potential opportunities before they become obvious to the broader market. The other cool thing is this has kind of got two orders of magnitude. We are staying ahead of the crypto crowd. That is still an order of magnitude ahead of the greater investment community. So you're liable to be right twice. You're going to be ahead of the crypto crowd, which is an order of magnitude. That gets you a 10x usually. And then when Joe Sixpack comes in with the Bitcoin ETFs and all this kind of stuff, you're going to get another order of magnitude. And there is likely your 100x. And yes, this is, you can rewatch these shows whenever you want. Just subscribe to the channel, the Nick Black Live or whatever that is. And then you can watch all this stuff. We have tons of it. Anyway, so think 6 to 9 months ahead, position yourself to capitalize on potential opportunities before they become obvious to everyone else. Do your due diligence, have a keen sense of curiosity, have the bravery to kind of like actually do the things you think you should do. Be smart about your position sizes, right? Invest with the assumption that you probably are lighting all of your money on fire. But if not, potentially you be rich. And kind of keep that in the back of your mind. Now, I was going to kind of go on this. I guess I could do it quickly. I did a timeline of cryptocurrency, kind of a brief from back till now. And then I was going to do the same thing for Fed funds. So I'm going to go through this fast in the same way that they do, like, you know, at the end of a car commercial where they're like, oh, this is a 2.9% APR. And they like read it really fast. So I'm going to go through this pretty fast. But essentially, this is a brief timeline of cryptocurrency. And I'm going to do the same thing for the Fed, for the yield curve in the same time periods. Let's think 2009 to about 2022. Okay, 2009. And by the way, Bitcoin white paper was October 2008. A few months later, January 3rd, 2009, Bitcoin, the first cryptocurrency introduced by Satoshi Nakamoto, who is a group of people, whatever, doesn't matter. Initially, Bitcoin had no market value. It established the concept of a decentralized digital currency and solved in computer science the Byzantine generals problem, which is a whole other thing we could go into. All right. 2010 to 2012, first Bitcoin exchanges emerge. Bitcoin's price starts to be determined by the market. These early years see a lot of volatility, but the price is pretty low, below 20 bucks, right? So from 2009 to 2012, below 20 bucks, okay? 2013, Bitcoin surpasses 1,000 for the first time, but also witnesses significant volatility with a bunch of drops. Altcoins, alternative cryptocurrencies start to emerge, like Litecoin, which was just a bullshitty thing that Charlie Lee did. It was a cash grab. He grabbed the cash. He effed off, and thank God he's not in the community anymore because he's a piece of shit. Anyway, oh, did I say that out loud? That's weird. That was internal monologue. Anyway, 2014, Mt. Gox. Oh, I remember the day this happened. I know where I was. It's crazy. Anyway, whatever. 2014, Mt. Gox, major Bitcoin exchange, goes bankrupt after a large-scale hack. I'm not going to go into how connected Mark Karpelès, the owner and CEO, was to that. But Bitcoin's price crashed and then started to slowly recover. Real quick, about 850,000 Bitcoin went missing. The minute they put the cuffs on him, luckily he found 200,000 Bitcoin. Oof, good thing he just found those in his couch or whatever. Weird when the handcuffs go on, what happens, huh? Anyway, God, can you imagine what's going on? Oh, that crypto, the FTX thing. God, what a damn nightmare. Anyway, 2015, 2016, cryptocurrencies start to gain wider recognition. Ethereum launches in 2015, introducing the concept of smart contracts. 2017, the cryptocurrency market sees exponential growth. Bitcoin reaches nearly 20,000 by the end of the year and then summarily crashes. So that was through 2018. What a bloodbath that was. It was a kind of a slow, melting, painful death, but not a death. ICOs, initial coin offerings, become popular. But by 2018, the bear market had kind of gripped, a bearish contractionary market in cryptocurrency. Prices of many of the digital assets dropped significantly. Some of them like below a penny. So a lot of the scams and stuff just kind of poof, gone. Then you go 2019, 2020, the market begins to recover. Institutions show increased interest. Remember when Facebook said, we're coming out with a coin. Everybody's like, what? Diem, stable coin. Everybody's like, hell no, you're not. And then everybody was, crapping all over Facebook. And he was like, what, man, Jesus. And then you had PayPal and they said, hey, we're interested in crypto. And everybody's like, what? So Bitcoin then starts moving again. It surpassed its all-time highs in late 2020. Go into 2021, COVID times, peak retard, the worst behavior ever. All sorts of stupid people that got no business with money, period, were getting free checks. They were getting checks to sit on their couch and not go to work. So what they do, they got into Robinhood and they punted that shit into the market, knowing nothing. And most of them lost because they know nothing. And that is probably the way it's supposed to be. I mean, all of investment is really just rookies handing their money off to veterans, I think, over time. Anyway, increased interest by kind of bigger institutions is like the main story of 2020. By 2021, you have all-time highs coming again. You have peak stupid. You have free COVID money. You have The cryptocurrency market surpassed the 2 trillion mark. It closed in on 3 trillion. You had a lot of institutional adoption. The development of DeFi kind of really kicked off, decentralized finance. And then you have, it doesn't take long to move through 2022. And you see the end of 2022, things start to look ugly. Companies start to collapse. I mean, and then you can go through the list of all the bad actors. There's too many to name. Anyway, brings us up to now. Things are quiet. And at the beginning of this year, AI took a bite out of the universe. And it apparently is still hungry and is not done. Okay, let's talk Fed funds. This is a lot easier. 2009 to 2015, after the financial crisis, which was really more of a monetary crisis, but that's neither here nor there. Fed funds was kept at near zero, 7 to 25 basis points to stimulate the economy, only not with real money, with bank reserves, and banks can't use bank reserves, so they don't do anything. Anyway, 2015 to 2018, Federal Reserve starts a series of rate hikes as the economy shows signs of recovery. By the end of 2018, Fed funds is at a range of 2.25% to 2.5. So 225 basis points to 250 basis points, 2.5. 2019, in the face of economic uncertainty, because it's always uncertain at the Fed, they make 3 rate cuts, bringing the rate down to a range of 150 basis points to 175 basis points, basically 1.5% to 1.75% by the end of 2019. 2020, in response to the economic impacts of COVID, the Fed slashes rates to near zero, and real was zero. Nominal was 0 to 25 basis points, so a quarter point in March, and they commit to keeping them low for the foreseeable future. 2021, rates remain near zero, with discussions about potential future hikes as the economy starts to show signs of recovery from the pandemic. Then comes a period of peak stupid where the Fed misunderstands supply shocks, misunderstands microeconomics, can't read. They can't read. I was going to go through the list of things they can't read, but really I think they just can't read. And here we are. They've raised. Okay. So why do I go through all this? Well, because we need to do some comparisons and observations. The main takeaway is I want you to think about low interest rate environment, risk appetite, and dollar weakness. This is kind of more of a macro thing, but when you think of a low interest rate environment, we're now in a higher, not high, 5.5 is not high, but higher interest rate environment. But you need to think how the regular market, that next order of magnitude, is looking at the crypto space. So when you have prolonged low interest rate environment, this kind of post 2008 situation that led up to just the recent rate rises. But when you're in a low interest rate environment, the general thinking is it is likely to drive investors towards higher risk, higher reward assets like cryptocurrencies. So the thinking is there's no money to be made over here in the debt market. I'm going to go out there. I'm going to release the animal spirits. We're going to go out and we're going to invest, right? The risk appetite. When you have periods of economic uncertainty or when the Fed indicates their kind of dovish tones, investors are more willing to enter speculative markets, including cryptocurrency, right? The risk on, right? When you have dollar weakness, periods of expansive monetary policy and low rates can weaken the dollar, obviously. As Bitcoin and other cryptocurrencies are often priced against the dollar, or at least in dollar pairs, they can sometimes act as a hedge against dollar devaluation for some investors. I have to asterisk this, caveat this. Bitcoin has not in kind, in time, like if you chart it, it doesn't necessarily track inflation inversely like it's supposed to, but over time it's performed better than inflation, meaning it's still one of the greatest performing assets in human history, period, full stop. But Kind of like gold in the near term, gold does not perform well against inflation. Actually, gold does not perform at all against inflation. That's been a failed bit. That's basically why I left the gold business, because everything that it was supposed to do, it did not do. But anyway, to sum it up, when you look at the behavior of cryptocurrencies and Fed funds, when Fed funds are low, if you look at the yield, like, let's say we had two curves and we looked at cryptocurrency against Fed funds yield curve. And yes, they're influenced by a myriad of factors, especially the fact that like the cryptocurrency space is just it's still very new, right? But these prolonged low interest rate environments likely play a role in increasing the attractiveness of things like cryptocurrency to mainstream observers, right? To people not in the space like we are. On the other side of it, when we take a high interest rate environment, such as the Fed having rates at 5.5 for a prolonged period, which is what they say they're going to do. And again, it doesn't matter what they say, they'll do whatever they have to do to appease the public, because they're a propaganda organization, not a monetary authority. But in kind of a hypothetical situation where the Fed holds rates to a prolonged 5.5, like they say they'll do as of a few days ago, we can make some educated assumptions. We can make some assumptions on traditional investments, cost of borrowing, economic growth, speculative assets, strength of the dollar, liquidity of the market, and DeFi. And so I'm going to run through those and fill your brain full of goo, and then we'll call it a day. Traditional environments, higher interest rates. Again, this is using the established, right? Not for us. This is for the mainstream investor looking down on us as they do. Like, even if you get rich in crypto, everybody thinks you just won the lottery, right? They're like, oh, you lucky son of a gun. Like, oh, really? Are we lucky? But anyway. So on the traditional investment space, higher interest rates make traditional investments such as bonds more attractive, because, you get 5.5% by sitting in government debt. On the other side of it, can they inflate that shit to dust? Yes. Can they debase? Absolutely. And tips don't really protect you, because tips are based on CPI. But let's not get too nitty gritty here. Higher interest rates make traditional things like bonds more attractive because they have a higher yield. Investors looking for steady returns might reallocate assets from riskier classes like stocks and cryptocurrency to bonds. Well, think about what you saw when you had UST and Luna and all that bullshit. Think of all the dudes that manage money, even in the crypto space, that just took all their money and threw it in Luna and UST for the 20%. Why? Because you can't get 20% anywhere, man. Look, bro, why do you think I was so happy to lock my tokens up in HyperPG? 9%? You're going to guarantee me 9% on an asset I think is going to either stay the same or appreciate? Sign me the F up. That's real money. Anyway, so even in a space that has a lot of potential, when you start getting guaranteed percent, 9, 12, 15, 20, it makes people like really pay attention. So investors that are looking for steady returns allocate assets from riskier classes to things that are more comfortable or perceived comfortable. And yes, the price of the bonds go down, but the yields entice you in, right? And Sam, I agree with you. That's not where I would be, but you can see why people managing a fair amount of money might move their clients into those less risky assets that at least have no default risk, right? So cost of borrowing, higher interest rates increases the cost of borrowing. This is a weird kind of one-off, but yes, it is true, right? It's not direct. Like, for instance, the Federal Reserve doesn't set borrowing rates for banks. However, banks kind of pivot off of those treasury rates. So not quite the same. It's kind of like a one-off, but it's very close. They're correlated. So this could lead to a slowdown in spending and investment for both consumers and businesses. Companies that rely on debt financing, commercial real estate, could see their costs rise, potentially impacting their profitability and stock prices. We're seeing, we're seeing wide scale right now, shitting in your pants, commercial real estate panic. I hope you guys realize that's what's going down right now. That whole market is about to get like Fukushima'd. Let's just say it that way. Anyway, economic growth. Historically, when you have sustained high interest rates, it can slow down economic activity. Although the thing that's different about this is that it's the reverse. It's that slower economic activity tends to push people into these less risky assets, which tends to make it look like that's the reason. And it's actually not. It's a reciprocal of a slow market. Slow markets where you don't think you can lend into or invest into, you typically find yourself hiding in safer liquid assets. It's not the cause, it's the effect. Anyway, it does not, I don't believe it leads to a slowdown or recession. I believe it's a harbinger of a slowdown or recession. Cryptocurrencies and speculative assets in this kind of environment, given that speculative assets like crypto, which, again, illiquid assets on illiquid exchanges traded by sketchy ass people, are often looked at as an alternative to traditional investments. They might see a decline in demand as traditional assets like government debt become more appealing, that the safe trade. Historically, during periods of tight monetary policy, riskier assets tend to underperform. Why? Because people are not investing in those assets. Strength of the dollar. Higher interest rates typically attract foreign capital looking for the best return, right? The cleanest dirty shirt. So this can strengthen the US dollar, and a strong dollar can, in many cases, reduce the attractiveness of things like gold and potentially cryptocurrencies. Gold, for sure. Cryptocurrencies is not so clear because you have a whole technology play that's the underbelly of crypto that doesn't exist in the gold trade, obviously. So as a hedge against dollar devaluation, there are people that just buy gold because they think, oh, the dollar is going down, I'll buy gold. That hasn't really worked out. But this is the traditional thinking. Liquidity in the marketplace. A high interest rate environment tends to reduce liquidity in the market. Reduced liquidity can exacerbate volatility, which might make speculative markets like cryptocurrency even more volatile. However, for us, that is a good thing. We like the volatility. It gives us a lot of opportunity. Anyway, DeFi platforms. Decentralized financial platforms, which have been popular in the crypto space, they tend to revolve around lending and borrowing. High interest rate environments in the traditional financial system can impact the lending rates and the dynamics within those DeFi ecosystems. So that's kind of important. So essentially, kind of to wrap all this up, while it's difficult to predict with certainty what a prolonged environment that we're going to be in now, this 5.5, maybe 5.7 interest rate environment set by the idiots at the Fed, whether that will lead to a shift in investor behavior, making traditional investments more attractive and reducing the demand for riskier things like cryptocurrency. There's a tech underbelly to all this, and AI, which is eating everything. So the unique characteristics of the cryptocurrency space, and especially where cryptocurrency and AI merge together, we're in the infancy of this partnership between AI and crypto. And so compared to traditional markets, you look at the technological developments, there's where the orders of magnitude come from. And I think it's like crypto plus AI is like a liquor store. You buy it when things are good, and you buy it when things are bad. When things are bad, you drink because you're unhappy. And when things are good, you drink because you're happy. I don't. I hope no, but many people do. And when things are expanding, I want to be involved in AI. And when they're not, I want to be involved in AI. And the way to do that in a relatively disintermediated way where there's the least amount of information asymmetry is where crypto and AI come together, right? So stay ahead of the pack, right? Just, campfire, the bear comes. You don't have to outrun the bear. You just have to outrun the fat kid. So that's kind of the discussion about intellectual arbitrage and then how you might look at crypto versus Fed funds over time. And it all kind of melts into the same bucket. All right. That was a lot. You may want to play that one back while you're driving down the road, but definitely focus on the road. I have like all these cool self-driving features on this car that I have, but I'm too scared to use them. I'm kind of I'm not ready. I'm not ready for that. Yeah. Don't get fat and you won't be the fat kid. Well, you know how to not get fat in intellectual pursuits. Just roll up your sleeves, do the research. Don't be afraid to do the research. And don't be afraid to question or suspend your own belief system. Don't fall into gurus and groups and all of this old bullshit. You need to find multiple sources of information that you trust, which is sometimes tricky. And also try to pay attention if you're being sold. Like, everybody's selling something all the time. We're selling. Listen, we have Digital Investor. We're selling that. You should be like, what are these guys selling me? Why are they giving me this free stuff? They want me to be a Digital Investor client. Yeah, of course. I'm a material girl, and this is a material world. You know what I'm saying? Anyway, we'll see you tomorrow for Digital Investor. I'll be recording tonight or this afternoon with Tufi. We'll have a This Week in Hypercycle that's coming tomorrow morning, probably 7 a.m. it will drop. So, that's funny. Anyway, throw some likes up there because the office hours is free content, and hopefully it's meant to help people that might be that don't have extra currency units to devote towards their education. And by all means, you should not spend a single penny that you cannot afford on anything, period. Not just, on anything. So just be smart, listen to your wallet, listen to your bills, get out of debt, get out of credit card debt. Jesus, get out of credit card debt. Let me say that again. Get out of credit card debt. That's the first damn thing you should do. If anybody here investing, if you have any credit card debt, stop. Go and solve that right now. You sell whatever you got to sell. Get out of debt this second. Then come back and we can begin. And on that note, stay in school. Don't do drugs. Don't do anything that my poor, insolvent, drunk, strung on meth grandmother would not do. And as you know, that's very, very little. Brandon and I will see you tomorrow bright and early. Woo!
Accredited investor and you want in on angel, seed round or early round equity and token opportunities in the artificial intelligence and cryptocurrency space, schedule an interview at nickblacknext.com. In life, you can either be really good, really lucky, or just be first. Being first is so much easier. Schedule a digital private client interview today at nickblacknext.com.